Billionaire investor David Tepper from Appaloosa Management bought a new stock in Q3. Well, bought a couple of new stocks, but one specific one I want to cover in this video because it is the best performing stock in the S&P 500. It's been a battle. It's been Nvidia, then it's been Palantir. Well, actually, no, it's been Nvidia, then Vistra, then Palantir, and now it's Vistra yet again. As you can see right here, Appaloosa Management did buy Vistra last quarter, a completely new position. He also bought NRG Energy, should I say. Now, you might say, okay, new position shouldn't be that big. Well, it's already the 12th largest position in the portfolio. He seemed to be extremely bullish on China, right? Number one and number two are Alibaba and Pinduoduo, and that's 26% of the portfolio. Then you've got Amazon, Microsoft, Meta, Google Alphabet, and then you've got another Chinese company, which is JD, which he added another 65.35%. Pinduoduo, 173.25% increase, by the way, last quarter. He did reduce Alibaba a little bit. Remember, he's the guy that said, buy everything. Clearly, he didn't buy everything. He even sold some. But Vistra is a new position, and it's already in the top 15. Now, if you don't know what Vistra is, well, you've come to the right place. Let's discuss that company. Let's talk about why this company has gone up so much this year and why still today it might actually be a pretty good company to have in your portfolio since, well, all the AI expectations are going to go on for quite a long period of time and you're going to need quite a lot of energy to make that work. Not just fossil fuels, but nuclear as well, renewable energies, etc., etc. That's where Vistra comes in. So if you're interested in all of that, sit back and relax, hit all the buttons as well. We really appreciate that. We are very, very close to reaching 60,000 subscribers. So thank you very much for all the support and thank you to all the new members of the channel. I really appreciate all the support because, well, you don't really have to do it, but I guess you're all super kind. So I really appreciate that. If you want to support me even further, do check out the links down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's start with a major overview of the stock and the company. So Vistra Corp has a market cap of $51.75 billion. As you can see, year to date, it's up close to 300%. It also pays a small dividend, has a dividend yield of 0.58%. And forward PE right now sits at 19.8 times. Now, when you see this number, of course, we've seen much higher numbers when you look at big tech companies. 19.8 times in the next 12 months compared to 29.3 times in the last 12 months. Okay, not that alarming, right? Not that alarming, but we have to dig a little bit deeper. EV to sales, 3.8 times, EV to EBITDA, 12.6 times. Now, let's see what the analysts are expecting in the coming fiscal years. So, for fiscal year 2024, they expect sales growth of around 15.5% year over year, and EPS growing much, much quicker, 94.22%. In fiscal year 2025, sales growth of around 14%, EPS growing 44.2%, and then in fiscal year 2026, sales growth continues to decelerate, 6.12% year over year growth, but EPS growing closer to 12%. As I said, this is a company that pays a dividend. It now has a shareholder yield of 0.91%. So you've got the dividend yield, 0.57%. Then you've got a buyback yield. You will see they've been buying back quite a lot of shares. And then you've got here a small negative impact of the debt pay down yield. Yes, it's a company that holds quite a lot of debt, but shouldn't really be that much of an issue. Now, with regards to dividend, if you bought this stock back at the end of 2019, you would be getting 13 cents. Now you're getting 22 cents. That's quite an increase, right? You can see the annualized growth. The last 3 years, that's closer to 14%. As I said, this company has been buying back quite a lot of shares. In the last 2.8 years, shares outstanding have been reduced by close to 30%. Looking at some pricing metrics and comparing it to the 5-year mean, it's pretty clear that it now is more expensive than before. But before, bear in mind, they were not growing as much as right now. Right now, they're also actually acquiring some companies here and there, so that helps with revenue growth, but did hit them with cash flow just for the quarter. So you have to take that into consideration. But They provided us with some guidance for next year and even for 2026, and it does look like this company is going to be quite a good one and a cash generating one. So yes, if you look at EV to EBITDA, if you look at price to sales, price to free cash flow, it is much, much higher than its 5-year mean. Now, to understand a bit what Vistra does, let me explain it a little bit and play some videos. So Vistra operates a diverse fleet of power plants, including natural gas, nuclear, coal, and solar facilities. The company sells electricity to residential, commercial, and industrial customers under various brand names. Vistra is also investing heavily in battery storage projects to complement its generation portfolio. Now, this year has been the year of nuclear stocks, right? We've seen quite a lot of nuclear stocks. For example, Oklo, the other one, Constellation Energy, they have been going up and up and up. And there are a couple of reasons for that. Because, well, big tech companies have started to announce some partnerships, some agreements. So we've got one from Google. They signed an agreement with Carriers Power to purchase nuclear energy from multiple SMRs, small modular reactors. This deal aims to bring up to 500 megawatts of carbon-free power to the United States electricity grids, with the first reactor planned to come online by 2030, followed by additional deployments through 2035. And this is what I've been saying for quite a long time. Nuclear stocks have gone up quite a lot this year, right? That's in anticipation towards a move where, well, we are going to see a huge transition towards SMRs, towards nuclear energy. But it's going to take a long, long time until these things get approved, build out, revival of older plants, V1, V2 plants. It's going to take a while. They will have to figure it out. It's not, oh, they have an agreement and next year we're up and running. No, nothing like that. So yes, the stocks have gone up. Is it worth chasing? Some are actually already making money, such as Vistra right now. But a lot of the other ones are just in anticipation of, well, 2030 goals, 2035 goals, etc., etc. I'll make a separate video about Oklo and some others as well. It's interesting, but there is a lot of future growth already baked in that stock or in those stocks. We also had AWS. They announced the participation in $500 million of Series C1 financing for advanced reactor developer X Energy. They also partnered with Energy Northwest to construct a 4-unit 320 megawatt plant in Washington, and with Dominion Energy to explore advanced reactor development at North Anna Power Station in Virginia. And then we had Microsoft. They signed a 20-year agreement with Constellation Energy to purchase power and restart the 3 Mile Island Unit 1 nuclear plant in Pennsylvania. So of course the big guys are already making some moves. Now, switching back here to Vistra, what has happened before and what's expected to happen in the future. The revenue growth we have seen already before, but look at free cash flow, for example. Free cash flow for 2024 is expected to be $2.572 billion. Then in 2025, $3.4 billion. And then in 2026, $3.7 billion. So yeah, a free cash flow generating company. And to be honest, I expect this to continue. If we then look at total revenue, free cash flow margin, and gross profit margin, it did come down. Free cash flow margin, as I said, they've been making some acquisitions. So in this case, free cash flow did impact it. But of course, if you look at adjusted free cash flow, then, well, you are not seeing that negative impact. As for the last quarter, they delivered $1.44 billion in adjusted EBITDA, solid results despite a milder Texas summer versus 2023. They're also upgrading the 2024 adjusted EBITDA guidance range to between $5 to $5.2 billion and adjusted free cash flow before growth. Yeah, this is the first time I'm seeing this. So adjusted free cash flow before growth guidance to $2.65 to $2.85 billion. Then for 2025, they're initiating $5.5 to $6.1 billion of adjusted EBITDA. They also give us the adjusted free cash flow before growth guidance that will be in the range of $3 to $3.6 billion. And then for 2026, adjusted EBITDA midpoint opportunity of over $6 billion. They allocated $3.5 billion of capital to equity repurchases in Q3, so around $3.1 billion towards Vistra Vision minority interest acquisition, and around $400 million of open market share repurchases. They also have a comprehensive hedging program, so they're 100% hedged for the remainder of 2024. around 96% hedge for 2025 and now 64% hedge for 2026. I mean, if they can stay on track for that over $6 billion, that's the midpoint opportunity for adjusted EBITDA in 2026, that is quite bullish, to be honest, quite bullish, and it's probably worth paying a small premium today. Now, if we do a quick reverse DCF here, I'm using free cash flow trailing 12 months. We know that for 2024, it's going to be higher than this, but we have to use the trailing 12 months one. We can see that with this discount rate and terminal growth rate, how do you reach that? It's basically those two numbers right here. We see that implied growth rate to justify today's price is 6.7%, meaning they'll have to grow free cash flow by 6.7% in the next 10 years to justify today's price. And to be honest, I think that is justifiable. Could even be a little bit higher, but of course you want to have some margin of safety here. There is also a 2% dilution included in that reverse DCF. And I mean, we've seen that the market is expecting free cash flow to reach $3.7 billion in 2026. Here, based on these figures right now, $3.7 billion is only expected to be at, well, year 9 or so, 9.1, 9.2. So yeah, 6.7 to me is quite reasonable. Looking at the charts right now, well, we're back to all-time highs and we are overbought a little bit right now. Now, as you can see previously, this stock has been overbought for, well, a long period of time. Actually, it was overbought from November 6, 2023 all the way to June 2024. So I will keep repeating it again and again because I know not everybody watches the same videos, but you can stay overbought for a long period of time and see your stock basically go from $34 all the way to $105, $106. And yes, these things exist and these things happen. Now we're back at all-time highs. We've seen a nice rebound here in the last 2 weeks from that 50-day moving average. It did dip a little bit underneath it, but rebounded quite nicely above that. So all in all, a solid buy, I would say, for the Appaloosa management portfolio. It makes sense for them to buy it I don't know exactly when he bought it because those things are outdated a little bit. We only get the numbers from what happened last quarter. So maybe he's been buying more in the last couple of weeks, maybe already sold. We don't know. But I mean, when you buy stuff, you want to buy good companies to hold for a long period of time. And I think Vistra is in an amazing position to benefit from, well, everything that's happening with AI, but definitely benefiting from moving towards renewable energy, moving towards nuclear energy and things like that. I think this company is in a perfect position. And well, there is a reason why, right? There is a reason why this stock is up 300% year to date. So all in all, very good company. We'll put it on my watch list. We'll maybe cover it more as well. If you have it, let me know down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye-bye.